What up, everybody? Markets opening, resilience less than zero. Already out the door, looking like a gap down situation. Trading off the box here. See if we get a good thing on liquidity map. See if that comes out with anything decent here. How you guys doing today? Smash that like button. Let's get ready to get started. So we said, are we having a call? No call. It's weird, all my posts aren't showing up on my Twitter feed for some reason. I don't get. Oh, resilience is looking hot and sexy. Oh, nope. All right, so we are short against hedge pressure if I get there. 959. I'm gonna hold out on this one. Positive rise can flex us through the box. I don't think I'm gonna touch that one. We have index divergence here, so resilience is negative. It's already down here. Liquidity map. I'm going to short at 418. Wait for res get to be 0. We already tapped DD, so I guess DD will be kind of my exit target there as well. Any upside will have limitations as VIX hits that as well. So you can watch for UVXY pivot. Yeah, all my posts on my Twitter feed aren't showing up for some reason. Like I made a post and then all of a sudden Twitter hates me. So weird. It says I don't have any posts. Is Twitter glitching for anybody? Oh, it's so weird. Bought the right dip. Oh, very nice, very nice. No, it's on my phone too. Like all of my posts are gone on Twitter. My posts from this morning. Oh, now they're back. That's weird. Somebody's glitching out on Twitter. Now it looks like I'm shadow banned. They're back. Look, when I refresh Twitter, they're back, and then when I post something, it doesn't show up. So odd. Okay. I'm gonna wait for the swim. That's what I'm looking for today. Mm-hmm. Let's look at monthly map spy. Alright, so I'm gonna wait and take a short on hedge pressure. Still bearish monthly maps, still at the same look. Same look. See, it didn't change that much from yesterday, so I mean they're committed to that. Right? It's so weird. It hates me. Still looking nasty for the bullish liquidation. And okay. So we're gonna wait on. I'm gonna wait on this one. Definitely a short setup today if I get it. Okay. Gonna let it play through the box. Okay, we're kind of at half cap already. Let's start building a little bit right here. Half cap negative. Oh shit, I forgot to change that. We tried setting it where these settings would save, but it's like a trading view thing. Shorting out inside of here. Oops. I'm going to build a position. I'm going to short here and here and here. Did it remember my tweet? There we go. For some reason, it hated my tweet. I couldn't retweet it. All right, you guys. Let's go, let's go, let's go. Be back. All right, smash the like button, friends. Let's go hit it, hit it, hit it. We'll wait for y'all. Don't forget, every morning you got a chore. I'm gonna ask that you know the rules. Hit that like button. You know you love it. You love to do it. You love us. Come on, I trade circles around you trading gurus. We get that, drop that free knowledge for y'all every day. Teach y'all how to run this game. So res is positive, so I might get a little bump to go my way. Scalping on the open here. So Nasdaq resilience got a little better. So res positive is going to flex through the box, right? Res less than 0 going to go through here. We're looking for liquidity map short off a hedge pressure. I get it. I got a starter position just in case up here. DD. Res is positive and reflecting through the box, which is really odd. So why don't I just go ahead and take that profit, 100 bucks, let it move up higher. And if I'm getting the sell off I want, I might have closed it early, but let me just lock something in just in case it does bounce. That's a quickie trade there. All right, let's see what else we got. Monthly maps still look like garbage. And there we go. So that's basically it. We already tapped DD band at the start of the day, so we already have these kind of like small, trade half kind of signals anyways, which I'm already on. By the way, I'm on like a massive, what's up? I'm on like a massive winning streak. I don't think I've lost a trading day in like going on 2 weeks now. I think I may have to turn like every day into a win, which is great. I really need to go back and review the broker statements so I can be accurate on that claim though. I think I've only lost, I don't think I've lost since like 2 weeks ago or the beginning of last week maybe. We'll see. Well, there's the trade I wanted. So when you have multiple options here, here, and here, like I said, I was going to build a position in each one of those spots, right? I was going to short here, I was going to short here, and I was going to short there. I just took a small starter position here to here. Once it filled the gap, I closed out because this was hugging zero, and I was going to just kind of take a scalp and then wait some more. The end of the day, obviously, is DD. This is where we're looking for, you know, at least some interaction point. We already failed float today, so market's 100% random from here. So it's failed from the start. If you guys all checked out Rocket Scooter and subscribed yet, I don't know if y'all have done that. It's only going to be, if you do it until the end of this week, $20 for 1 month. You can just kind of check out the platform and learn from us. Those Zoom calls I do are the bomb. You're going to learn trading from a pro. You're going to learn how to day trade from somebody who, really the only person out there who shows every trade live, full transparency, profit and loss statement, broker statement, everything. $19.99 for that. For that full experience. Data platform. When's the next deal for lifetime? Great question. Probably Black Friday. Do you want the Black Friday deal early? We'll do one. Send me a message in Discord, because it is getting close to the Black Friday deal. That's always our big one. So float failure happens. So because when you do float failure right here, float failure, uh, 100% random, right? So market's gonna behave randomly at this point. So I take it with a grain of salt. I get really, it's gonna be choppy or above triple B, or like VIX above. Let's just write this here, VIX. See how I just close out my trade, VIX above triple B. I'm not going to be greedy. It's going to be choppy. Overshoot pivots. All right, I'm trying to review. I need to get my tablet back on for real. Second right. Choppy overshoot pivots. Res is still negative. Getting a second chance to take a trade off of this. All right, this is getting us another setup there. All right, what do you guys think today? Good morning. What's up, Cheyenne? Caleb's a patient man. I love that. Okay. So I'm waiting for my short entries here. Res is bounced at 0, trying to make a run for it. Where'd the cool music go? All right, here we go. Need some water. Be right back. All right, all right, all right. How's this week going along, by the way? Doing a good week? Just waiting for a better setup. Rez is starting to fight, so I really do think that today is going to try to make its way somewhat higher. I'd love to slam it down back to 0, back to start. Reload. Yeah, let's take a look at what's going on today in the data. Look up the calendar real quick. Home sales in 12 minutes. Maybe the catalyst we're looking for. All right. Watch out for home sales coming out. Home sales 10 minutes. Like I said, everybody, check out this spectacular coupon. You can check out our Rockets Good platform for 20 bucks. Right here. Full access to the data. I don't know how people trade without this information anymore. Once you see it, you can't unsee it. Once you get really, really tight on res, DD, and liquidity map, you're going to realize that. I mean, you're watching me trade with it, and the results may vary, right? I don't use technical analysis anymore. I don't change the time frame of my candles. I haven't lost a trading day in 2 weeks. This helps with my position sizing down here in the bottom left, bottom right. I can look for what the greater sentiment of the market is right here. Kind of get a feel for what's going on. Best streak was 5 months consistent. Dude, nice. Sitting out, that's where your consistency comes from, right? Being patient, waiting for a move instead of just chasing everything. Dude, I watch people, there's people that like try to stream trading and you know they're fakes and phonies because they stream like every couple of weeks and they delete their losing streams and stuff like that. Or they stream at weird hours of the day, or they upload their stream later instead of doing it live. There are all kind of guru tricks out there for them to fake it. Every day, same time, same trade setups, same plan, never delete a stream. That's what we're here to show you the whole process, right? Throw me your favorite trading guru, and I'll trade circles around him. I've thrown so many open challenges out there. I offered somebody 10K one time. I said, I'll give you $10,000 in an account, and I'll put one in an account too, and we'll race for charity. The winner, then everybody puts whatever is left in both their accounts into the charity of the winner's choice. Sounded great. You know how many people took me up on that offer? 0. One person trolled me for a couple weeks with like all kind of stuff like, yeah, I'll do it, but like maybe, but like no, but like maybe, but like, oh, you changed it. I was like, here's the account, here's the number, here's the login. They never showed up. They were all YouTubers and trading gurus and stuff. 0 people wanted you to see them trade live. Put that in your pocket and smoke it. Customers and clients out there. 0 people. 0. That tweet had 50,000 impressions. Probably something like that. Everyone saw it. Nobody wanted free money to trade with. How funny is that? For charity too, right? 0 takers. And I told people, I said, post your favorite guru traders in here. And people posted all of them. They all saw it. No one stepped up. I can't reset a live account, so I was like, you know, I thought it'd be fun, and of course that was a poke at the industry too, right? Just to show you, nobody's gonna sit here and show you everything live like I do. I show the results, stats, everything. Every week I post up my broker statements. You can see what happened that week. So I wasn't lying. I literally post the account balance up in the Discord. Okay. And one person in particular spun it so hard on their YouTube channel. And they were like, who does this guy think he is? Blah, blah, blah. Yeah, sure, I'll join, but he'll probably back out, or I'll join probably this way. It had like, you know, the 20 people that watched that person was like believing it. I'm like, show up, here's the login. There you go. And literally it was just like such a spin. I've never heard somebody spin something so hard. Like to literally, like, they took it personal that there was a challenge out there. And I was like weird, so I said nobody's name in particular. They literally took it personal and then fought so hard to dodge it for weeks, literally mentioning it every day. And how embarrassing for them. But at the end of the day, like, I was like, it's okay if you're gonna dodge, just don't take it personal and make a campaign out of why you're dodging it. I don't know. Some people just try so hard to make you believe they're trading. I don't know. I guess that's what that was about. But anyways, the reason I say that is because it's really hard to do this, and I want you guys to know that there's very few people do it. It's like, here's Anne Marie showing up here. I love that she comes in here. She's been doing this. Anne Marie's the real, you know, trading expert here. She's been doing this longer than I have. There are people that have been fighting this fight for a very long time, and like, you get the TikTok and Instagram kids come out there, and they try to make you feel like it's easy, and you gotta realize you gotta pay your dues, right? If you're a dude and you don't have gray hairs in your beard by the time you're 40 from trading, you're not trading enough to learn the game. So it's hard. That's the point of this, is that not everyone can do it, but the impression out there is that everyone can do it, and so can you. Very easily you can do it. Join my Telegram. Easy monies. And because everybody out there wants to start a trading business in COVID, I get it. But not everybody out there wants to let you watch them do it because they don't really do it. That's the statement I was making. It's very rare that people do this, and it's even rarer that they show you that they do this while they do it. It's 1 in a million. That seems to be millions of them. But anywho, y'all are funny. Yeah, this market's going nowhere so far. It's just moving around. It's doing like essentially nothing. I think I was wanting something like that to happen. Everybody knows. Y'all see the writing on the wall. Monthly maps are showing there's just bearish, you know, general bull liquidation event. Markets becoming more volatile, as Ashton's reported many times. Ashton loves reporting on this volatility. Volatility is expected to go up. We're still in a choppy overshoot pivots type environment. So the market is going to be choppy as volatility expands, right? We have that downward pressure where I went to short from here. I just took that one scalp. Hey, it's $100 I didn't already have, right? But at the end of the day, since I know it's choppy and overshooting, you see how I broke my trade in the thirds, right? Thirds. It's because you can't really predict every pivot exactly where it pivots. You know, they're all possibilities, right? You know, it can hit here, here, or here. So I take each one with pieces. I didn't jump in and YOLO it short, even though I could have. I still play it smart. When you spread out your trade wider against all your pivots like this, your probability that your win rate goes up. Because you don't miss out on a trade. You at least take a little bit, and a little bit. So you can get a monster trade if you get all three of them. You get a small trade if you get the first one. Not that it seems that impressive on the small account. That was $120 or something. And then that's it. That could be the end of my day. Already I'm trading medium size as well because, you know, these lights triggered. We already had what we call float failure, right? We tapped that lower band when it shouldn't have. And the DD ratio is still bullish enough. Tech is still looking good, right? Some of the sectors are looking good. And banking is looking kind of booty. So at the end of the day, the market just is chopping its way down, and that's what we know. And so because of this, I'm not going to take a strong long position or strong short position anyways. So I'm going to split up in the thirds. I was going to do 5, 5, and 5 for a 15 short from there and there. R&R was pretty good. I'd stop if we broke hedge for sure by a strike and call it a day. So see, so at the end of the day, like I'm showing all the pieces of this. Resilience is less than 0. So we're fluxing through the bottom of the box like that, like you see. Right now with res is less than 0. This is res less than 0 as well. For outside of the box, that's going to be pivoting there as well. DD band is my lower target on that, but we already tapped it once. So when I get there, I'm just going to get out of the way if I was in anything at all. Okay. And so Travis is saying Leonidas is saying they don't want smoke. A lot of people, I think, in the realm. There's two types of, like, I think, educators in the streaming or watch me trade space. One is there's either somebody who is trying to build the impression that they do well all the time, There's three types. The first type is your penny stock pump and dumper. They're going to be on YouTube or something because they're going to try to gather as many people as they can to watch them trade. Because as soon as they get in and you get in after them, that bumps their stock up, and they're doing that whole game for a reason, to make their trades get more liquidity. So that's the bad type, worst type. Second type is someone that faintly uses like YouTube or Twitter or Instagram or something to show off a gain here or there. Don't show off any losses. Don't show any consistent pattern, like trade every day at this time. You know, upload late videos, stream once every week or two. You know, the stream shows up at 4 p.m. while they were trading at 9 a.m. You know, clearly it's not watching them day trade live, but they call it day trading live or streaming live, whatever. And that's just an impression builder. They want you to think that they're doing it all the time and showing you the best versions of them. And that's your Lamborghini trader. That's your guy on Lamborghini, your guy that's like, hey, check out my penthouse, check out my Lamborghini, check out my swimming pool, check out my whatever. Right? Check out this, check out that. That's the look at me guy or girl. They want you to see what they want you to see. That's the Instagram lifestyle, the filtered lifestyle, the impression is all that matters. And then the third type is your trader funding program whore, essentially. They're just a paid gun, and they're out there funneling people to trader funding programs, which means they can paper trade live all day long, and they're paper trading live. Because trader funding programs are all paper trading. And there's tons of those, and they're super competition right now for clients. So everyone out there is an affiliate of some paper trading funding program group, and all they're doing is trying to funnel you to them. And so they're paper trading, so not really trading. That's the downside of that. You can see them, you know, oh, they made 5K or 50K or 10K, and it's all a paper account. There's no real risk there. It's not the real money account. So it's not really getting a good education, because paper trading is not really good for learning anything. This is your three types. Not to say they're bad people. They're just not, that's not who I'd want to learn from. I want to learn from someone who paid their dues in the real world. That's how I am. Rented Lambos and penthouses. Yeah, check out me on the airplane going to wherever type people. So yeah. Okay, so here's it. This is the end of the day, guys. I drew this at the start of the day. This is what I was expecting to see. I wanted to get a little higher up a hedge, but this is basically it. This is the end of the day today, so there's nothing else from here. But I still would say it'd be fun to have a charity trading challenge. I know a bunch of really good traders who I'm friends with that are out there in like Spaces and Twitter and all other places. I'm friends with a ton of traders, but the good ones are really quiet. They're not so like, they're not so, hey everybody check out how good I am kind of people. And even me, I'm not like a super braggart about it. I mean, I'm kind of cocky because I know I'm good, but I still kind of only cocky to y'all. I don't go on Twitter and start beef with people to be like, I'm better than you, I'm usually quiet about that. If anybody steps into my house and offers a challenge, I'll wipe the floor with them. I'll lap them 2 or 3 times. I wouldn't lose. I know that for a fact. So I'm good. Stuff is crazy. It'd be great to be at the points I made to do charity challenges. I mean, over time, people slowly improve at trading. I've been doing this for almost 14 years now, right? Full time, like almost 9 years now, full time. As you get better, you realize every day I do the same thing. I'm not doing anything magical every day. I'm doing the same routine every day. The only thing that's different are the slight differences. I get a slight different delivery every morning of what's in front of me, and I have to make a creative decision. Once you've done it a million times, it's like playing basketball, right? How do you fake someone out? I mean, like, you know, Akeem Olajuwon had the dream shake. I'm from Houston, right? Somebody's trying to block you when you're shooting. How do you spin around them? I mean, he's got basically like one move. He spins around you. But every time he did it, it was like slightly different. Like, it's just kind of like the same thing. It's like that slight difference, that 10% different each time, is like the slight difference in the market. Every day it's the same thing. Liquidity map, resilience, and DD. My system works for me very well. I wait for my setups, I sit out when I don't get them, and then when I know it's a volatile environment, I play small and spread it out. And once you do that over and over and over again, it does become a lot easier to manage trades because you have routine. And that takes practice. So don't sweat if you're not there yet, Kyler. Charity challenges would be fun. I agree. I think it's fun. I think it's cool when we draw a crowd or whatever. But right now, the popular thing amongst the gurus is paper traders are calling paper traders out. It's really funny for me to see that. And they all have big followings too, and a lot of people watch them. But I think that's just because they're not selling services or something. I don't really know. But there's a paper trading fighting ground. It's like all the adults in the room are like, oh, that's cute. Look at the kids fighting with each other, calling each other out. You're a fraud, you're a fraud, you're a fraud. I'm just like, sit on my porch, drinking my iced tea in my rocking chair. Yep, oh, those kids are frauds. It's an old joke because I just turned 42. What? I'm over the hill. At the end of the day. Check out Kiki, touch of opening, negative resilience, nice entry. Did you check that, Benji? Anne Marie says Rocket Scooter has been a game changer for size for you lately. Truly. Oh, I'm glad that you said that. The sizing, especially in futures, because your futures is extraordinaire. It's like having some position rules in futures was something that was hard for anybody to come out the door at, because there's really no futures is the easiest way to blow up super quick because you get a lot of leverage trading futures. So trimming positions and getting out of positions to me has been like one of the hardest journeys in futures, is to create some way to be able to do that. The lights over here, the position sizing, when they're all green, you know, I go in my normal position. It's not 100% doesn't mean full port. My normal position is based on this. So what I do is I take the net lick of the account and I divide by the margin requirement the CME sets. This is for futures. You guys want to know my futures position rule? Grab a pencil, write this down. I'm going to teach y'all really quick. Futures position sizing. Okay, so in futures, FUTURES. Typically your brokers will give you day trading margin, right? So they'll give you like, you know, $500 for trading contracts for something that should cost you tens of thousands, and you can lever up pretty heavily. So this is a trick. You're going to go here to the CME website. Okay. You're going to go to margin requirements. You can write this number down. They don't change that much, especially for index futures. You're going to click on CME span 1, not span 2. Pick up your asset classes. We'll go to CME. We'll just pick futures, equity. Yes. And you're going to get the margin requirement, right? This is the minimum margin requirement clearing should charge you, and not the split that you pay with your broker. If you pay $500, your broker's putting up the rest of the money. So let's go ahead and get the number, 11.2. So we're gonna write down that maintenance requirement. It's equal to 11. Write down this number. This is a trick, everybody. If you're trading futures, especially if you're trying to trade these combine accounts and whatever, to pass these trader funding programs, use this rule. Okay, so maintenance requirement is here, what we call the initial margin requirement. You multiply the maintenance. You multiply it by 110%. Easy as that. So this times 110%. That equals what? 12320. Okay. So for futures, this is the equation you take. Say that we have a $24,000, your account balance every day you can adjust by the same equation. What it does is it removes margining. I mean, you're not trading on margin anymore. You're trading almost as quickly as cash equivalent as you can. This will keep you inside of a realm. This is a genius thing, I promise, right? You learn every piece of what I'm teaching you. So you take your number of your account. This is an arbitrary number and make something up. 24,640. And say that the number we calculated was that's how much you should pay per contract. Your broker is going to be $500 per contract. Don't ever take that. Don't take the bait. They do that so you pay more commissions when you trade. You're going to blow up faster. Okay? So if that's the margin requirement, I have that. The answer is 2. I should trade no more than 2. 2 max. So 2 is my budget. So 2 minis, the price of an E-mini is max, or 20 micros, okay? So choose the 20 micros route. That way you get a chance to come here and split your position up to make multiple entries. You can get, you can do 4, 6, and 10. That adds up to 20. Heavy, heavier, heavier. You can do like, 3, 7, and 10. You can do like 6, 6, and 8. So you can have 3 different entries in smaller position sizes. If we're trading above triple B, you can chop your thing up, right? You can't chop up too many, so trade micros at that time. What this equation does is the following. We know that a risk interval, this is the smartest part of what I'm trying to teach you. The risk interval is how much the futures market will move rapidly on an event. It's currently 31 points for the S&P, and you can do this for any futures contract. Watch this. This is magic. 31 points. If you limit yourself to this max position size, and the market just randomly drops 31 points on a catalyst that goes against you, okay? Because typically what a risk interval is how much the futures market strays away from the equities market very quickly before it hits resistance. You will see that all the time. 31 is a magic number. So if there's a catalyst that just strikes against you, it'll usually stop about 31 points lower with its first bounce before it keeps going or doing whatever else. You get a moment to breathe on a risk interval. What you hate to happen is the market fall and blow you up before you get a chance to breathe. So we take that account as it's the max instant move you get on the snap of a finger. So 31 points, right? If you make $500 every 10 points, right? So 31 points is going to be 31 times, $50 per point is $15.50, right? For every contract. So 50 points times 31, you're going to lose $15.50 per contract. If we limit ourselves to 2, then on a drop that goes against you, that's $3,100. On a $24,000 account, a risk interval drop will drop you about 1/8 of your account, which is about a 12.5% loss, which means you'd have to be in a trade for a catalyst to snap against you 8 times in a row for you to blow up. This rule limits you to your ripcord being about 12.5% at max worst case scenario. So if you limit your position sizing to a ratio of your account, divide the margin requirement, get the max position, then you have a budget to play with. Then the worst case scenario, if you don't go over, the market moving a risk interval against you is only going to drop 1/8 of your account. That rule is the secret to my trading challenges. That rule is how I do it. So that's the worst scenario you can expect that gives you a chance to breathe. The market just doesn't plunge 30 points without you getting a chance to stop on other stops. But that is our DD band, is a risk interval up and down. The market, if you do this, you will limit your account. You're basically just removing margin from your account, not allowing yourself to trade on margin. You're treating it like cash equivalent. So with that being said, one single trade should never blow up your account unless you just freeze and don't do anything. The market's rarely going to move multiple risk intervals in a day unless there's just a travesty going on. DD bands, as we know, typically you interact with them in pivot. DD band is a great example of a risk interval from yesterday's close, even 31 points. It loves to pivot off of these things. And then, of course, a catalyst, which is the one thing that does blow you up in those trading challenges, is a snap of a finger. Fed comes out with something. You should know that's coming, so stay out of the way of events on the calendar. But say you're just trading, and then somebody tweets something or says something that changes everyone's mind. Fed just makes a surprise announcement, surprise someone new, and it goes against you. Typically, you will always see that you get a moment to breathe. There's at least a reaction before it either reverses or goes. But that risk interval is that moment in time that it goes. It doesn't just fly forever and blow you up. It's the rarest thing for the market just go in a straight line. Risk interval is usually a very quick stopping point. Gives you enough time to breathe. Sometimes it holds there for hours. Sometimes it holds there for just a minute, a couple ticks. The market will hit that and start testing the waters. And so that is my limit for setting my position size. The worst case drop, the highest case margin is not going to blow me up. And that's my trick. So divide your net lick by your initial margin. You get that from the CME site. There's your budget, 20 micros, whatever you do. I just made an example. So as your account grows, your position max grows, and that's your max position, which we call your budget. If you wake up today and you know that you have 3 possible entries, and the example mine was I have 20 micros to trade, then as it goes up, I'm going to stage in each one of them. 4, 6, 10. I get heavier, heavier, heavier to really move my cost basis up to the final spot if I go. And now I've hit my max budget here. Each one of these sets me fine. If I stop just 10 points beyond there, nowhere even close to blowing up, right? So this is the prevent you from blowing up on a normal trading day and prevent you from blowing up on a catalyst goes against you day rule. And that has been my secret to trading futures and growing a small account to a large account, because you just scale your position slightly higher. If you guys remember at the start of the challenge, I was trading 4 and 5 micros. Now where we are now, I'm trading roughly, I don't know, 20 something, but I actually modified my challenge to trade my equation double. So I'm trading what I call 2x risk. So what I've done is I've chosen I've modified the equation to take a little more risk, to turn that 1/8 into 1/4, just to speed up the challenge. So I'm actually taking my net lick times 2 and then dividing by the other thing. But that gives me 4 days of catalyst blowing me up. So that's a choice to speed up the challenge. But again, it's my choice to take. So in my current account being like in the 8,000 range from the 5,000 start, you can see that the 16,000 range, give or take, divided by whatever that was, $1,300. I should be trading about 13 max, right? Give or take. And that's what you have been seeing me do on the stream. I've been trading about 13, 14. So that's it. Rinse and Lamb, is it possible to compare the scale of this week's bull liquidation to 2022 bear market levels? I wouldn't. This bull liquidation is going to be worse than the selling of 2022 if it picks up, because there's volatility on top of this bull liquidation. We never really saw massive amounts of bull liquidation in the 2022 selling. It's going to be completely different. Somebody says, since we've already walked over the lower DD band, would you expect us to approach it now? Nothing. I don't try to guess. If I were short, I would always close here. Markets are random. So the day is over as of now. The trading day is over. No more trades for me. Day over. But as we drew at the start of the day, trading here to DD was what I wrote on the stream if you are here at the beginning, right? So that's what I would have done had I did it. I just took one scalp from here to here. Rez wasn't giving me the sign I wanted, closed out and called it. And I'm just going to watch it for the rest of the day. Hope is on a trade. Travis said agreed. Because you logged in too late, got down 250 res, went negative, short all the way back, $10 feels like a win. Hey man, anytime you, well, it does feel like a win, because a losing trade and a winning trade is not 2 parts of a day. It's 2 different trades. So you had a loss, and then the second trade was a win. You didn't get it back. Your second trade was a win. Forget about the first one. You make the second one. You kill it. Emilio's on year 4-ish, killing it, brother. Emilio's a superstar in the making. When I was his age, I couldn't even dream of being a trader. So start young. He's gonna be one of the bigs in the future. Name drop. Oh, you're talking back to like the other people from the trading challenge. People are taking it personal. Like I think that the impression that some people want to make is I'm the best and no one's better than me. And when someone like me issues a challenge, they take it personal because it threatens to put a spotlight on their claims. I mentioned no one by name, but the person was just like, they sent people in the stream, they sent people in Discord, they trolled us for a little bit. It's like, who are you? like you can either just accept the challenge or not. It's free money. I'm paying for it. But yeah, no name drops. I don't ever drop names. I'll just say it was rather embarrassing for that person. How are you supposed to learn this if you have a job? David Lovenisi says. If you have a job, how are you supposed to learn trading if you have a job? Good question. So different types of trading. Well, you can learn by you know, at least in our program, you can watch the videos and study how markets move after the fact. A lot of trading platforms have market replay. Thinkorswim has one. I think NinjaTrader has one. I don't know if TradingView has one. Maybe TradingView has one. We don't have one, but we could have one where you can go back and practice trade the market, like start over at 9:30 and push the play button, like rewind, and it plays through the market like normal, and you can trade after hours, just like it's the morning, and simulate the experience. So that's a good way to trade if you have a job, to learn trading. And then if you want to really trade while you have a job, clearly you're not going to be able to do all the things I'm doing here, like sit here and stare at it for hours. As you know, my strategy has me trading about an hour max, maybe at 2 if it's a bad day. But you always see me in the stream pretty much out of position by usually 11 a.m. Eastern. So you can market replay to practice. You can try trading setups that don't have you needing to start the candles all day, like swing trades. An example today, a very easy example today would be is to learn from Ashton Nolan, which is a guy in our group, which is how to learn how to trade options. But it's not day trading options like the YOLO 0-day people out there. Ashton's a smart cat. So while today, if you watched today, I said I'm shorting from there to DD. If you go to the beginning of the stream, remember when I said that? So I have 3 and I'm like, I'm gonna short each one of these places. We're not gonna break here. There's another kind of trade you can do. It's much easier than day trading. It carries a little more risk because you have risk of losing your whole position if you're wrong because it's options, but it is a slower, easier to do trade because you don't have to be focused on here. You can set it and forget it and know your risk. Say that you have a $100,000 account and you want to do trades like this. Allocate how much you're willing to lose a day. Let's make an example, 2% a day on your trading account. So your budget is $2,000. In an equities account. Instead of my rule for futures to set my maximum, just arbitrarily set it. What are you comfortable with? How do you determine what you're comfortable with? Well, I say it's how much money that you're going to trade with. Pretend that you lose that every day for 5 days. If you don't feel like you got kicked in the stomach, like you're so sick you're going to vomit, then it's probably a comfortable position for your normal. We also say that's your normal position for green lights. So if I lost 10K after a 5-day beating in the market on a 100K account, I'd be pissed, but I probably wouldn't be throwing up in my stomach. I'm like, oh, that's a lot of money. But shit, I had the worst lucky streak and I only lost 10% of the account. Okay, I'm fine. You know what I'm saying? Like so I'm going to set my budget per day 2,000. And now I want to trade the idea that, okay, I wake up, all you need to do is block 10 minutes of your day to understand what the market's going to do. I know what the market's going to do likely within 10 minutes, and I know where I'm going to be wrong if I'm wrong. So the commitment is 10 minutes. So if you work and have a job, market replay every night, and then every day at 9:30, go take a 20-minute shit, literally, and go get your laptop and do your trades. Set it and forget it. Find a routine when you can trade. What you would do in this situation is, you know that it's likely to resist here, here, or here and come down, but the takeaway is where my final stop is, we break hedge pressure. So instead of betting on where it goes and watching it to go there to get the day trade, you can do what's also called the don't go trade. Now in trading, you can trade where something will go, which is shorting or longing, and where it won't go, which means you can sell options. Buying options and selling options are opposite sides of the trade. If you want to bet that it doesn't matter what this does, if over an amount of time it just doesn't go here, and you want to make money, so it can go here, it can go here, it can chop around, it can do anything that it wants to do. As long as it doesn't break hedge pressure, you make the full amount of your trade. Then you can sell options. And Ashton teaches call credit spreads and put credit spreads. You can sell a credit spread. And what it does is it's just a one set it, forget it trade with a fixed risk. You just set it and go about your day. You're kind of day trading in a way. You can buy and sell 0-day credit spreads, which is like make a trade today, lose the 2,000 or lose a limited amount of that 2,000 if you're wrong, make some money if you're right. What you do is you would sell calls and betting that it just doesn't break hedge pressure. If you're convinced it's going down, then sell calls above hedge pressure. And if you sell them for today, as long as the market closes anywhere below it, you made 100% of that money. Now, instead of just selling naked calls, obviously there's risk to that, infinite risk if you're wrong. You have to do another type of trade, which is part of the spread. You want to buy some kind of call as well. So you'd pick another pivot to buy calls on. So what a trade like this is an example. If my calls were here and here on a call credit spread, right? Well, this would be more like a debit spread if they're one-to-one, because you're buying expensive calls and selling cheaper spreads. So this is a debit spread. So it costs you a little money to make this trade. But here's what this tells you. If the market ends up anywhere down here, then minus your debit, you make the full amount of premium on those calls. Right? You lose your debit, but you win the trade. Whatever the calls are, you're protected in case the market goes inside of here. These still make the full premium. This is your best trade right here. If it goes inside of here, you win both of these trades. And then if it goes up in here, you're just protected on a fixed loss. Because you have calls that are in the money at higher delta than the calls you sold that are out. So this is winning while this is losing. You're going to have a fixed total loss. So you can structure options trades to win if the price lands in a range at the end of the day. Which means you just mark it up real quick, set your trade, try to get your fills really quick, and then just let it go. So in this example, inside of here is where you make the most money. Market falls down here, then you only cost whatever the premium difference is here. You sold one, bought one. And if the market goes over, it's a fixed loss. And so you can do all kinds of trades. You can do like sell a call here, buy a more expensive call up here. I'm sorry, buy a cheaper call. So you can go this direction. You can sell a credit spread instead of buy a debit spread. You can sell a credit spread right here. I think that's the sell side of that. If market lands anywhere down here, you make the full credit. So market can do anything. If you go inside of here is your worst loss. That's the worst loss. You lose on both. So it needs to land inside of this tiny little area. It's the worst. And if you go up here, it's a fixed loss because you are losing and winning one. So worst loss, fixed loss, 100% win. So you win your credit. So that's just an example of other ways to trade. You don't have to stare at it. You just set it and forget it. And at the end of the day, you either lose a fixed amount or make a fixed amount. So it's like day trading without day trading. It's trading for the course of a day, but it only takes a little bit to set up. And you're not trying to watch it. You're not trying to get out. You just let those options expire, and then you come back at the end of the day. So swing traders do that. Over periods of time. They'll sell them for like weeks out. If you want to day trade with the credit spread option, you just set it, forget it, and then at the end of the day, you just take your profit. But the credit spreads have fixed, or put credit, call credit spreads have fixed losses. So that's essentially like a stop loss. You can't blow up your account. And if you limit how much you put in, then you fix your loss maximum. And that's the way to do it. Another thing is you can trade overnight. I don't recommend it. We have pivots for overnight trading, dynamic hedge pressures. It's kind of, overnight trading is a little harder than daytime trading because it takes a lot longer, a lot more of your time. But if you're working full time, you can learn trading by doing the market replay. It's still kind of paper trading. It's not real risk, but at least you can learn the game there. And then swing trading, swing trading is also a way to do it. Where you also can try to load up Rocket Scoot in your browser at work and just day trade when nobody's looking. But don't get fired from your job by dicking around the office. That's your real source of income as a human being, not gambling in the stock market. So don't ever risk that. But hopefully that's some tips to help you. 3 good candles, rest. Can't say no myself. You're your favorite, Anna Elizabeth. You're my favorite. How you calculate IRLs, illiquidity pivots? You don't see this in Discord? Oh, yeah, it should be there. It is in the exit targets rules. There's a bunch of places where it is. Hold on, let me show you. So yay, pop-up here made 100 and something bucks today. Let's go. You go here, learn the trade. So I'm putting entries first instead of risk management. This is because as I'm finding out, people are like, it's just too hard to learn. Because you put risk management up front, and this is the stuff you need to learn. But people like go through these 5 things. They're like, I don't get it. It's like, and I'm like, no, you should get it. That's the trick. So what we're going to do is we're teaching entries first. Let's just dive right in and get you right in. Exits are the other things. So you have predicting pivot points in S&P from pivots in the VIX. Oh, this is rule 6 of 6. VIX pivots. Six of 6. Okay. These are all our exit rules. And so you're going to have illiquidity pivots here. Red lines, yellow lines. You want me to teach you how to do it real quick? Hang tight. Don't go anywhere. Go let me let it think or swim here. Any trades today? Yeah, I made 120 bucks in the first like 10 minutes and called it. Profit sub. Glad you admitted it's gambling. Not enough people admit that. It's more like poker than gambling, which is gambling with fixed odds, I guess. I ain't saying not fixed odds, but like gambling with control. There's a random element and there's a predictable element. The predictable element is that you have some sense of control over, you know, in poker, it's like there's a certain number of cards. In trading, there are some mechanical things that limit certain things as well. And we try to exploit those things. Now, it's not as rigid as far as like limitations in poker as giving you straight odds that you can calculate every time with precision, but it's enough to have if you have an edge, then you can utilize that. But yeah, it's exactly how you control your bankroll the same way, 100%. Yeah. It's just like it's the same shit as poker. It's like you're gambling with odds. It's not roulette where it's a random roll. Now, the candle price action is roulette. No one can predict what the stock market's going to do, no matter how many people try to tell you they can. But we can predict certain elements of the mechanical side of things, and we try to wait till those things line up and exploit those things straight up, right? And then bet that they happen with a flexible probability that's not like poker. But at the end of the day, that sense of, stock market's pretty much gambling with a little more control than roulette, but a lot less control than poker. It's like somewhere in the middle. Somebody said very clever. Oh, Amber, you're talking about my position sizing rule. That allows you to scale your position size as your account grows as well. So if you fix that ratio of 1x or 2x or however you do it, since I'm doing 2x on the small account, I'm limiting myself to like 13 to 15 micros. The account doubles, that would be 30. So it allows me to have a fixed percent drawdown on futures account as the account grows. The percent stays the same. So what that does is as your account grows, your drawdown is bigger on a cash basis, but relative to zero, the percent that you don't lose per trade is relatively the same. So my equity curves are ratioed to where I don't have like ups and downs like that, unless it's a really bad lucky streak. That rule has been the secret to my success. Just growing. I've done these small account challenges so many times over the years, and I'm doing this one right here. This is a 5K to 100K. I know it might seem like much, but the 5K right now is at 8K. Right, and I don't think I've lost a trade day in like 2 weeks, and it's only been like 2 weeks we've been doing this, a little over 2 weeks. So it's just gonna start picking up steam, and by the end of the year, I should be relatively close to the end. Well, let's see, November, December. I'd say by January, February, it should be at the 100K mark. I'm just going at this pace, and it's just to teach traders how you just slowly crawl your way there. I've done it a ton of times. It draws a huge crowd, that's why I do it. I'll be straight honest with y'all. I do it for the views. People like to come here because they want to see me fuck it up. And then I'm like, all right, come watch. So the more I do, the challenges, y'all love it. So that's why we do it. All right, let's do some redline calcs. I'll teach you guys this rule. This is called illiquidity pivots. That's a subjective analysis, but we are creating an algorithmic, like a fully automated way of doing this. So I'm going to put like a 25 tick chart, 5 days. Okay, let me show how this works. You know, like people come here because they're like, they want to see it screw up, which is cool. But I really just enjoy challenging myself. And this is what I think you guys learn the most from as well, because a lot of you are going to be different boats. And as I learned as the years went by, just straight trading with an arbitrary position size and not purposely challenging myself to grow an account with rules, then I find myself skipping those rules, right? If I'm growing the account and trying to do that same thing, I'm following the rules I teach people, which keeps me in check as well. Okay, so let's try to find an instance where this can be worth doing. Now, what you're doing here, now, one of the things is we're going to try to automate this at some point. It's very difficult to automate because it's there's a little subjective visibility to this. But an example is your brain can look at a chart, right? Everybody can look at the chart right now. This is a tick chart. So time independent tick chart, I picked 233. This is just an arbitrary number that I typically use because it's good enough to see everything in one spot. If you were to look, everyone do me a favor really quick. I'm gonna do a little science experiment on you. Everyone look down here at the axis. This is between 1155. And I want you to type in chat really quick. Everyone play this game, it's gonna be fun. And 1428. Can you identify on here, what do you think is the worst looking drop of all of these things? Meaning that which one of these looks like it had the most force of selling? I'm gonna show you something very cool. This will lead off in the red lines. Like, just look at the axis. Give me about an estimate time. Like, which one of these things do you think has the worst looking drop? Example, this is kind of a mild drop. This is kind of flat and choppy. Which time looks the worst to you in this whole thing? I'll prove the subjective part first before I show you how you do it. Very quickly. Isn't it weird that you're all saying the same thing? All right. Here's the experiment, right? So there is some magic to the subjective part, which means, right, so you guys can all, there is no, I didn't give you a strategy. I didn't tell you what to look for. I just said what looks the worst to you. And so we all agree that that's probably the worst looking one. And let me tell you why you all agree that. Because you see a bunch of red candles with no green. So a subjective rule set, like when you're programming AI, is like, if I were to point at an 8-sided red octagon and I said, is this a stop sign? Or if I say, what is this? You don't say a stop sign, right? So there's a reason that you all say that. This is one of those aha moments, is because you all see that the rule is basically in your brain, when you see a bunch of red candles without green, that's typically the worst drop. And that does make a lot of sense. While that's a longer move than this one was faster with no resistance because it moved very quickly. Rate of change, as Prophet Sub just said, I said move very quickly, it said rate of change. That's correct. So your brain is seeing not only the number of red candles without greens, but the slope as well. So these are the two things that are important to your subjective analysis, which means your opinion matters. You all share a similar opinion, like a collectiveness that all traders do feel and see, is that it's the number of reds without greens in a row, number of reds in a row, and then the slope, which is, as Prophet said, rate of change. We isolated a tick chart to remove time from the equation. So now you see that subjectively, you're going to have to create a tool that's looking at similar things your eyeballs will see. But let's use this as an example. But just the experiment is fun, right? When I say what's the worst, you're looking at that. So you know that that's important for your analysis. Okay. So what impact redline is, it's part of the risk interval tool. And part of the risk interval suite of understanding how markets move. When markets have buyers and sellers, they're going to bounce around. in between them, even if they're moving lower, because of the random Brownian motion of the market. If there are no buyers, the market will fall until they're found. The farther it falls, it means the further away buyers are. So the science of what you're actually seeing is the lack of buyers. So what I just described is, you may not understand why you all said 1230, but what you're actually seeing is that there are a severe lack of buyers right here. Inside of here, subconsciously, you don't know that you said this, but there are buyers here clearly because the market resists movement. Liquidity means buyers and sellers are close to each other and agree on the price, or agree on the frequency at which they trade. The lack of that, markets move in a straight line until they find the buyers. So pretty cool how when I just pick a random spot, you all agree, but none of you know why you said that. Like listing out the rules. You just feel it, right? Everyone, you just see it and go, that's it. But you never sat down and broke down what you see. That's the challenge of programming this. Now, what you all proved that it's possible to create an algorithm, because subjectively, your eyeballs and your inefficient human biological body and brain and mind all agree on something. So that means there's an algorithm that can also extract that same 1230 from this data set, right? We just got to figure out what it is. And we kind of already have. We have to list rules that we look for to isolate this, to automate it. But until then, let me teach you how you do it by looking at it. So is that pretty cool, right? So what you can do here is, okay, let me go back to like a random spot. So let's use this as an example, this nasty selling day. You come here, what is the worst drop of the day? We're all gonna say that looks pretty gross. So really what all you're doing is you're finding these following things. You're finding a move. First of all, anytime there's an event that catalyzes a move, you need to do this. But anytime you see a really strong move that has no retracement, and what I mean by retracement is typically every time the market moves in a direction down, it's moving to find buyers. And so if it finds them, the market usually pivots up and runs to the middle. The market is a very loving relationship with fractals. If a fractal is just dividing something in half until you converge. So it's like an infinite move until you converge on a place where markets are liquid. So anytime markets move, usually you'll retrace at least half to test the water. Okay, there were sellers here, there's buyers here, let's move it to the middle. That kind of makes sense if you're running the casino. Let's move the market to the middle to find buyers and sellers inside of this range. So typically every move kind of retraces a little bit. Up moves retrace, up moves retrace, down moves retrace, up moves retrace, etc. You're looking for down moves that don't retrace because you found an abnormal, and this is when I say subjective, there's no math to this yet. I'm just teaching a subjective way. You found abnormal selling pressure with no buyers. You didn't find the buyers there. Your brain all looked for that. That's why you described to me 1230. You saw selling pressure with no buyers. And so it kept going lower and kept going lower. And then finally it finds some buyers. Right? And why fibs are so popular. Well, the thing is that fibs, if you think about it, what are the numbers in fibs? 0, 23, 6. Let me show you how fibs are dumb and good at the same time. 50. Did you know if you did this and just wrote 25, you got yourself a half of a half? This is some arbitrary nonsense that somebody came up with because they wanted to write a book. If you make that 25, the market just moves half and moves half, and that's why fibs kind of work. It's the whole fractal nature of stuff. So in reality, right, retracements are pretty normal. It means that the other side of the market was found. So what you're looking for is a move that finds some buyers but doesn't retrace half. Move, find some buyers and doesn't retrace half, and you're finding when those buyers finally step in. So what you're looking for is a period where the market has volatility that increases and then decreases. So volatility would be like if you were to take the shape of the move, and again, the algorithm is that I've created does all of these things. We just need to actually make it. So if you're actually to measure that move and say this height is a V, and you're going to measure this move and say that height is a V, V1 is definitely smaller than V2. But this little V is smaller, V3, is less than V2. So you're looking for the period when the market was falling with no buyers and there was the highest amount of volatility to go with it. And the minute that volatility crunches up, this is your key point you're looking for. The move from here to here, it is an illiquid move, which means volatility is higher. So you're looking for illiquid move. So illiquid is the opposite of liquid. It means only one side of the market's there. Illiquid is volatile. Remember, volatility is the inverse of liquidity. So you're looking for an illiquid move that finds one side of the market without the other side, and you're looking for the V's to get bigger and then smaller. In this example, here's your little V. They're roughly the same size. Here's your bigger V, and then kind of like smaller V. Okay, that's it. So you're measuring from here to here. A nice, sharp, sudden move where the volatility peaks out and starts turning around. If you want other subjectivity to go with this, you're looking for the VIX to pivot as well, to go with it. So now that you've isolated these 2 points that matter, you're just going to draw a ruler between them and find the midpoint. That's it. It's called your impact red line. It's the moment that you have two things happening. You have a sharp, sudden move in one direction, where volatility is growing, and then volatility finally stops because buyers were found. Remember, volatility is the inverse of liquidity. So once you have the V expand and the V contract, it means that buyers were found. You're looking for a sharp sudden move where buyers are found, and that midpoint is always a pivot. Always a pivot. Always a pivot when you touch it. This is a high volume pivot. There ever was one. And then what you do is that this starts a move, and then you're going to copy this. We call this the anchor point at the top. A sudden illiquid move with no counter pressure where volatility expands and contracts. That's why we call them illiquidity pivots. One of the first things I ever created. And I found this was my studies in VIX early on, that I knew that when volatility crushed out, you can predict very accurately where return pivots will be. So what you do is, over the remainder of the day, you also trace from the anchor point the entire length. We call it a run length. This is called the impact, is the impact of the first event. And then this is the residual move, like squeezes and margin calls and whatever. If you trace it all the way down to a low as the market falls, remember, as the market's ticking lower, like here, where my mouse is the real-time market. I'm just dragging this lower, stretching that down. And as soon as I find the low, I stop updating it. And then as you see, there's your return pivot, right? It's like a 50 fib on the move. But it's calling it a 50 fib just sounds dumb because it's not really a fib. It's just the midpoint of the move. But you see that your high volume pivot. And I picked a random fucking spot just to show you how this works. And there's your pivot on the return trade from that impact. You see that high volume on a tick chart? Even that's before it returned. But what I'm telling you is that this is the impact. This is the first one we did. This is where the market is balancing that move out, exactly here. Is that the sound of you guys subscribing? This is a free course, by the way. And this isn't our paid courses. I love teaching this. My favorite things to teach. I mean, I pulled this day out of a hat, guys. To the tick. Literally to the tick. So the algorithm that I write has to be able to discover these things. We did it subjectively. We all agreed on what to look at. But you see how that works? The market is just searching for liquidity, and that's what you're exploiting. This is all mechanical here. So if I were to zoom out to like where I drew that, oh, I have to get more time on this. But that's what I'm saying. These things are very important. How far can I get back on a minute chart? Let's go 5 minutes, 90 days. I think you go 180 days. Let's go back and see what happens over a long period of time. But what you do is, whenever you map those things out, you have the ability to see pivots just on large moves. Now today we hit that, and these were major pivots, right? So anytime you have those big down moves like that, Let me leave it here and show y'all again. Remember, we just picked a day out of a hat. I just found a sharp sudden move and did this technique. I'll do it a couple more times so you guys can see it wasn't a fluke. But you found the move. This is called the impact, the run length. They are both return pivots. If I'm trading on the upside, there is pivoting there. If I'm trading, returning here, pivoting there. For like a lot of time. I don't normally teach on the stream. That's why I usually teach in the Zoom calls. But the Zoom calls are all lined up pretty good. And they have like title cards on them. But we should be revamping the stuff with the new platform. Let me update this really quick. 1 minute. Time chart. 90 days. Okay. So essentially what you're doing is you're just trying to find balance points on sudden illiquid moves that show volatility moving. And you can do it again with this one. I don't know if we ever returned to 43.40. Let me double check. Yeah, so we never returned to this one, so we won't see. But let's try to find one from, well, we did the one yesterday. Tick charts are the best way to do it because you get to see a little bit of granularity inside the candles. I do them on tick charts all the time. And you only get like 5 days of tick data on Thinkorswim. So yesterday, we kind of have a similar one that we did. Market opened and started moving without finding buyers. Like this, a straight line move like this. We could do the same approach here from yesterday. Anytime it retraces, it eliminates. So that no longer counts. Anytime you make your way to the middle, it no longer counts. So that eliminates that as being a possible anchor. So let's start over and do it until we don't find that. Anytime you move to the middle, the market has been liquid. You found buyers. You're on the other side of the trade. Well, let's find times where it wasn't liquid, like from there to here. If you were to zoom in very tight right here, you will see that we never made it to the middle. We were a tick away. That started the analysis. So that we make it. Yeah, we were 1 tick away. Oh. And we kept falling, and we didn't find the other side of the trade. And then we kept measuring and measuring and measuring. So that doesn't count. Okay. We're going to copy this one, and we're going to find that point until volatility expands and contracts. Look like it's exactly right there. All right, perfect. Oops. So this is the other one we're going to do. We're going to mark it all the way to the bottom of the day. Hold on. Let me double check that before I go in there and do it. Hold on. That really doesn't contract. These are about the same size. So let's move it down one more lower one. There it is. Okay. So one more spot lower. When I zoomed in on this, I realized that wasn't a good spot. Here it is. This one's very obvious. And this is the subjective part. There's your V. There's a bigger V, and then there's a smaller V. You're looking for this. These are roughly the same size. Okay. So that's it, right? So you measure that. This is your impact. This is where the market finally finds the other side on that sudden move, right? All right. Again, this is from a couple days ago. And we're going to draw like this. Track down like the longer move here. Remember, we're tracing. Anytime it hits the middle, you're done. So as the day goes by, I'm just finding the lower lows, the lower lows, the lower lows. Let's keep scrolling to the right. Lower lows, lower lows, lower lows. So I've got two lines, impact, and we call them just the run length, like the run of the day. And I mean, there's your pivots, guys. I mean, look at this one. Look how clean that is. And let's go to the time chart so you can see it. On the return trip, I mean, look at that. Look at that. Look at the ping pong between these things. Look when you hit it, there's your high volume. Look when you hit it, there's your high volume. You can predict these high volume pivots with this particular technique. Predicting volume. You're just predicting where liquidity is going to be. You know, you had sellers here. You know, you had buyers here when volatility crashed. And you know, you had buyers here because the market pivoted. So we call this a run length. We call this an impact. Impact is the first, where you bump into the first buyers and then a mad rush of selling, or the opposite. In a buy frenzy, you can do the same thing. Red lines on the upside. Call those impact red lines. We call them run length red lines. Run length is when the bulls have taken over. The impact is when the first buyers are found. And each one of these is a high volume pivot that you can predict. You see how that works? And they only last for the day. So when you're measuring the distance, it's from session to session in futures. Once the future session is over, your run length stops going lower. And then once you go to a new future session, what happens at the end of the future session is that the CME group runs the IOP calculation, and they gap the price accordingly to find liquidity. So in the live market, they're not gapping price to find liquidity. But when the market closes, it's a fresh start to move the futures price somewhere to find liquidity. So that squashes illiquidity pivots in their tracks. So they go from just moment in time, they happen all the way until the end of the session in futures, until the market opens and it's a whole fresh day. They last on your chart forever until they are touched. So does everybody see how cool this technique is? This is one of our 6 exit rule techniques that we teach in futures. Now the next step is to automate this. Put it on the charts for y'all. Golden session day. Thank you, Emery. Wish someone comb through Matt's daily videos. Well, it's amazing. I have to take it personally. I need to take things personally. Can anyone on Discord join the Zoom calls? If you're in Pro Plus, you can join the Zoom calls. Yes. Where are the new user training videos? In the boot camp. We're actually putting the videos on the website as well now. I have a project doing that exactly right now. Make it easier for you guys. You're going to go to the Discord after you sign up, and you're going to go to the boot camp. So all you do is you go here, and each one of these videos is like the same type of complexity. We go deep into the stuff. You can learn our 3 major tools, rocket skier, like entry rules, the exit rules. That's where this is. Red lines and yellow lines go together. But does everybody see how this technique of what I showed you? Now remember, it's a little subjective because I got to look at it and see it, but I got to write an algorithm that recognizes that shape and finds volatility pivoting as well, which is exactly how we're going to do it. I just revealed to you how we're going to do it. It maps out the 2 lines. The goal is you find pivots, high volume pivots, right? The fact that you can predict volume spikes at these levels means that you found liquidity. Higher liquidity means higher volume. Buyers and sellers found each other. That's what you're going for. And that is the secret to running lights on. What they're useful for is they are very great in illiquid environments if you need a pivot. Irrational markets like DD band breaks, you need a pivot. Your standing red lines and yellow lines, your standing illiquidity pivots that are there are the perfect pivots to take when you're trading outside of DD bands. So let's do a couple of them, right? Now, as you see, the minute you return to each one of those pivots, they're deleted forever. So bye-bye and bye-bye. When you isolate an anchor point the same way, okay, here's another rule. When you have this happen, you also need to measure a risk interval from what we call the anchor point. So this guy right here is called the anchor. It's the moment that thing happens that you're looking for. An anchor is a sudden, it's the price that market was at when a sudden illiquid move takes place, all right? You always need to measure one risk interval from the anchor as well, because what happens is if you have a run length of one risk interval or greater, remember our whole core, understanding of the structure of the market is this risk interval. Again, we used it earlier today in position sizing rule. We also use it to set up a catalyst. If the market goes greater than one risk interval, then it threatens to self-catalyze itself to increase volatility. Volatility goes wild when the market destabilizes more than a risk interval to find buyers and sellers. Because the risk interval is a number that is based on the positions of futures themselves, which is based on the margin requirements set by the CME, which is based on where people are positioned, which is telling you where buyers and sellers are. Their positions set the margin requirement. So this is an exploit of the margin requirement. If you go beyond that, then you're going beyond where people's positions are. You're going into no man's land. So a move of one risk interval from an anchor point, not just the two lines where you can find your pivots, but one risk interval lower, is a catalyst. The catalyst is active. You do not trade here whatsoever. If you have an illiquid move with an open run length red line that has not retraced and you move more than 31 points, you get the fuck out of the way of the market as fast as possible. The risk interval is one of our kind of proprietary methods. It's an exploit of CME span. The risk interval is the amount of deviation the futures market will take from the equities market when no trades are taking place, until it expects to find periods of illiquidity and liquidity. So the risk interval is a magic number. I'm going to show you what yesterday is. The market and major earnings fought so hard to fight off of that destabilization point. And it is a line in the sand where the market falls apart. Illiquid, wild liquid. Do you see how there's just some kind of strange repel type volume trying to keep the market stable? Because that's where your buyers are. Market is quoted and priced where expectations of buyers will be on those intervals. It changes when the margin requirement changes. But we parse the CME site and we deliver that number to you every single day. So you have the number for every futures contract here. We wrote a web scraper that pulls the data, and we reverse engineered CME span. So we give you the numbers. Why you don't run on TradingView? TradingView, oh God, TradingView can't do 1/10 of what we do, because TradingView, it doesn't have the flexibility to build what we need to build. Yeah. Why we don't on TradingView? Well, because we have to run. TradingView only allows you to plug in, like, well, I mean, we white labeled TradingView. Let me tell you what you can do. You can only plug in a data API to TradingView, right? And TradingView is only compatible with like certain data APIs. You just plug it in and go, and you really can't customize around it. So we white labeled so we can build off of TradingView's framework. So native TradingView is the best charting, web-based charting platform on the planet. TradingView is fucking amazing. That's why we picked them. But like natively in TradingView, you can't do anything we do here. You couldn't do liquidity maps, none of that. Because what we have to do is we take our data APIs and we run them through our own calculation boxes. Our data APIs go through proxies and send data different directions to do different calculations. It all comes back together on a database. And then we actually stream the outputs to you, like the alerts, the indicators, are actually WebSocket streams. So we don't do any calculations in the platform. And that is also one of our unique technologies here, is that all my stuff is proprietary, and you'll never be able to see how it works because all the indicators here are actually streamed from the server. So we don't do any platform side calcs, which is another reason what makes us like superior to like most all trading platforms, because we can have infinite complexity on a server. You're just streaming outputs. So TradingView limits programmers. Like if you go try to make an indicator on TradingView, you can only have so many outputs to the chart because the calculation is done on the chart in the browser. So if you're complex, your TradingView experience will slow down, and they don't want you to slow their platform down. So as a person making indicators, even if you're just making indicators, not much less extra widgets on the side, you can only do so much for TradingView. This allows you to make more. You can only have certain complexity, and you can only have so many outputs. You can't write an indicator with 1,000 outputs. We can write an indicator with infinite outputs. So because it's server-side calcs, the front-end platform doesn't slow down. No calculations on the front end. So there's a lot of limitations that us white labeling allowed us to be able to ride around. Yeah. So while TradingView is great, they create like a uniform experience for people, and like, so we like our marketplace that we're coming out with. So vendors like you guys out there can code and create your own tools and sell them in our platform. You're actually coding your stuff on the server side to broadcast forward. So you have infinite complexity, unlimited charts. We're gonna open up doors that TradingView can't do because of our server side technology. We're one of the first in the world with something like this too. We invented this, so it's a whole new thing. And we're opening up a marketplace on this technology. We've got 40 something vendors all ready to sign the minute we open the doors. This is going to be the biggest trading marketplace on the planet the moment we launch. We'll have more trading vendors in our marketplace than any other place. So, because of these things. And people like the idea of their stuff being protected on the server. And so anyways, going back to the technique I said, anytime you break below the catalyst line, let's go back to bragging about our marketplace here. Let's go with the lesson. The market destabilizes and volatility gets a little wacky. So let's show what happens if volatility gets a little wacky. When you broke the catalyst line yesterday at 11:40 in the morning, you can't make this up. Look what happened to VIX. VIX right here just flies out the door and gets a little wacky. So VIX is kind of like mild and then alarming, but at 11:40 in the morning, the minute you break through a cat line, which is 1 RI from an anchor point, VIX gets massive. I mean, this move here was about, 8 points. Now that, again, relative to itself, this one's about 10 points. You're going to see that in most cases, like this is a mild catalyst break, but you will see that volatility will inflect very rapidly below a cat line. The market is, tidy and tidy and tidy and a little bit of V, but down here, these Vs get much bigger and all over the place just on that one risk interval break. That is the beautiful thing that it's telling you. The market is massively unstable and volatility catalyzes further illiquidity beyond that. These are the first techniques we ever created that was like the framework of Rocket Scooter. This is like 2016 us. This is all we had back in the day before we built liquidity maps. We would trade off of these things. So as you see down here, you can see a very clear, easy break, right? The market has some V's shaped like that. Smaller, 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 medium, and down here, that volatility is expanding like crazy. Big V's. Literal breakpoint at 1 RI below. That's how good our calculation is. A catalyst line is one risk interval from an anchor point. That's all you have to know. And if you want to see how good that catalyst line is, another high volume pivot, let's zoom in on that. Now this is on a time chart. We can see on a 1 minute candle. Watch what happens when the market starts falling apart, becoming illiquid. Just here, the declining volume on average that you see starts picking up with volume spikes that are all over the place just on this break. Look at how volume on average, even the average volume, is starting to grow. Literally from a cat break, you're predicting volume growth from illiquidity. Yeah, this stream is gold. I'm sorry, we make you pay for this education. You're predicting volume growth, you're predicting volume spikes, you're predicting the market falling apart and margin calls. This could be margin calls down in here. Markets destabilizing, you're predicting volatility growth. Oh my God, look at volatility expansions. V's are getting bigger as you go down. Does everyone see this? Hopefully you're learning a lot today. These are things that let us see like, oh gosh, there are parts of the market that make sense. It's like the machine has broken and things are spiraling out of control. The fact that we can isolate this point is repeatable. This happens every time a catalyst happens. We have a lesson on this. So we're like, okay, how many more of these types of this happens every time can we do? And then we assembled all of our tools, and that's our poker. That's our odds. I know that down here, the market's going to just fuck me up if I do anything. So we have a rule that says don't trade when a catalyst is active. If you want to go back to our overview, you can read all 15 of our techniques, and an index catalyst is number 2 on the list, which means the second most important thing. Spontaneous, unplanned, or planned event, index moves one risk interval from anchor. I just taught you how to do that. It'll fuck you up, don't do it. Illiquidity pivots. We talked about this today. Single large positions where market is illiquid can create one directional move. Irrational creates illiquidity, great irrational pivots. Okay, so all these things today. Well, that's the next step of automation here. You're predicting where markets go out of control, where volume starts to increase, where margin calls are going to be, etc. catalyst or a no deal. Don't trade it. The market is completely spontaneous and weird and random and hard to predict. If you were in a long position and you get squeezed out down here, you get out of the way. You guys remember my trade yesterday? I actually took a wider stance. I actually longed right here, betting that the market doesn't destabilize. There wasn't an event. We had major earnings, so I don't bet that the market immediately falls apart. I took a long here and turned my loss into one. Actually closed right there at hedge pressure, because I bet that we float off of those catalysts and have to fight their way through it, because there wasn't an event. Nothing happened to cause that. So the market was going to break down on its own during major earnings season. It's going to have to fight its way there. So I took advantage of that. All right, questions? Marriage is gambling too. Exactly. All right. So it's a really cool technique that anyone can do and calculate. I mean, I'm just using in Thinkorswim to show you. The risk interval is a very cool tool. You can move this 31 point thing everywhere. Who was asking about profit sub? Yeah, if you have a tool set, give me a message in Discord. Join a Discord real quick and send me a message. Because right now we're doing a promotional thing for our first 50 vendors. There's a few slots left where we'll let you host for free in certain capacities. So if you're a vendor, make sure you let me know. We'll interview you and check it out. Adding on Twitter, Pine or Python. So no, we're not. So Pine Script is trading views, proprietary. This is their IP. They don't license out Pine Script to developers like us. So we're creating our own script called Rocket Script. On the front end, it's a trade script type trading script that allows you to code on the front end for yourself. If you want to make your own indicators on the front end, it would be not too dissimilar from PineScript, which is a JavaScript-based coding language. But when you write on our console, which we're calling our Launchpad, which means you're going to code in our server as a vendor, have protected IP, and broadcast your indicators forward like I do. You'll have a lock and key to that black box, and no one else will. You'll code in Rocket Script, and we'll have a translator that converts to your Rocket Script to Python, as people have an easier time coding in like a JavaScript type coding language that's based on candles as opposed to raw Python. So we'll give you like some documentation on the syntax. You'll code in what's called Rocket Script, and then it converts to Python for server code. So it'll run on the server in Python. It's super fast. So right now they're building like the translator and the Launchpad console environment and stuff. Essentially, you'll be able to launch a little app from the website. A little deployment app. It'll have a chart, a little input for you to type in your code. And then you can deploy it locally, see what it looks like on the chart, then deploy it to the server, and then it broadcasts immediately to your subscribers' platform. So the reason, so you'll be able to go in and add your own tools, and then immediately when you create a tool, then you can sell it on the marketplace inside of it. And the tools also, what's different here is that, by the way, here's your risk interval, guys. And you see the market just loves playing this 31 point range. It's really hard to unsee it. There's just a thing that happens, and it's just planned volatility in the market. And you can just see that like the 31 points, it's everywhere. It's everywhere. I mean, no matter what you do, you'll see it everywhere. Here's that big run up here. When the market ran up here, there's 31 points there. Markets love to move links of this risk interval, and once you see it, you can't unsee it, guys. Like the blocks and the moves are that much. This is what put us on the map before. Here's that move before it stabilizes. People are like, okay, these engineers are onto something. Look at that. I mean, it's the same distance all day long, all day, every day, in those big sudden moves. Here, here's 31 points there. Liquidity. Like I said, there's a little bit of control on the market. Here's the high, there's the low where it pivoted up, 31 points. It's everywhere. In every futures contract, we've cracked this code for all of them. So you can do this for oil, natty gas, whatever. It's essentially a feedback loop. Where people's positions are, CME Group will set the margin requirement, which allows them to hedge beyond those levels, which causes buffering and buying and selling at those levels. So the market moves that distance and naturally finds buyers because everyone knows That's where buyers and sellers will be. CME Group tells you that because they set the margin requirement to that limit, which is the expected move of a sudden move where futures can move on its own until it's kind of brought. It's like the rubber band that stretches futures from the thing it's tracking. And if you go beyond that, the rubber band breaks. Like if equities are ebbing along, futures are going to ebb along with it. People are bombarding futures by selling at the same time people are buying equities, and they stretch away from each other. At about the 31-point deviation, you're going to see the algorithms start to push them towards each other. It's like how far futures can deviate from the equities market before all hell breaks loose and the rubber band breaks. And that's exactly the way to visualize it. What's up, Phoenix? What's up, man? All right. So anyways, red line is a great technique. Yeah, send me a message on Twitter, Prophet. We'll chat with you later. Maybe we can hop on a call sometime this week. Y'all want to see the marketplace? I'm so excited. So I can find you though. Hold on. All right, I'm gonna let you guys vote on something real quick. Everyone do a vote before we get out of here. Do we call it... Everyone vote. Everyone get ready for this. Do we call it the Rocket Scooter Marketplace? Or do we call it the Rocket Place? What do y'all think? Marketplace or the Rocket Place? And then we'll call it a day. The Rocket Space Marketplace, Scooter Garage, hell yeah. We were throwing around cutesy names like, why don't we call it the Rocket Place? I'm like, oh, that's cute. Launchpad. Well, Launchpad is we're picking Launchpad. Launchpad was my choice for the console. Launchpad is for you to get. That's where you can get your tools to customers. Launchpad will be you get your indicator. Oh, and here's another thing just to kind of show you before I close out. Another thing that's going to make us different is that not only can you write in the Launchpad your own tools, so you'll have, candle data is your input, right? Candle data. You can write code to interact with the platform. And so not only are you writing code to interact with the chart, so you can actually write indicators. I'm gonna not write all this. You can write indicators, you can do signals, you can do alerts, you can do scanner settings. You can also present graphics or text feeds. So the output is gonna be a variety of things. The indicators and signals will output to the chart or to an alerts window. Alerts like these will input into the alerts window, can signal different alerts that also signal the Discord bot to alert people in your community. The scanner, your outputs could be a scanner setting. It can be a proprietary scanner setting you have that doesn't show people how it works. Graphics will be like the liquidity map. So here, my output is send this graphic file to this widget to show people the trade plan. So if you have a graphic, like a cheat sheet or something, your output could be, if these conditions ring true, send this cheat sheet to people in this graphic here. So you can create images to send to the platform. You can create text to send to the platform, like a text feed. All this is tied to Discord. All this is tied to input windows. You can send trading alerts to your clients. You can send instructions on how to trade in the platform, cheat sheets to the platform. So the outputs of your indicator can reach a broader segment of customers, not just like trading viewer, just coding indicators. And as we create more and more and more and more widgets, we have the ability to interact with the platform even further. And your clients will get base Rocket Scooter for free. Rocket Scooter is going to become a free product when all said and done. Those of you that are in a package right now, don't cancel it. It's the cheapest liquidity map is going to be. A liquidity map is an a la carte purchase for the free platform, which will be more expensive than what you're paying now. So don't, when y'all hear free Rocket Scooter, nobody go out there and cancel your sub. You can turn around and have to rebuy liquidity map. You're going to pay double what you're paying now. So don't ever change. the base platform with nothing in it will be free, and then you go buy your vendor tools a la carte. That's how it's gonna work. Here's the marketplace. This is the actual live website. It's launched. Now it's placeholders for now, and we're doing a couple more things on the front page for search, presentation. We're gonna have a carousel of different people. You can search for different things. We're partnering with some trader funding programs, some newsletter groups, everything. You'll have the ability to have your entire trade room community business model hosted under here. So, Rocket Place, dude, Rocket Town for Final Fantasy. I know, right? Launchpad's gonna be the console. We'll probably just keep it Marketplace. See, I pushed back on Rocket Place too, but Adam and Ashton, I love new ideas. Adam loves it. They were coming up with cool ideas, so Adam really loved it. And I was like, I don't know, it's kind of like, it's cute, but like Marketplace is just like direct. But Launchpad sounds cool. It sounds like different. All right. Rocket Place sounds like a ball pit McDonald's. No shit, it does. It kind of does. It really does sound like a kiddie playground at a fucking fast food place. So one of the neat takeaways of Rocket Script is that we'll be able to communicate to the different widgets. Oh, and displays. One of the things is that if A or B happens, toggle off a display. So another thing is that you can actually code to toggle off displays in the indicator as well, not just, you know. So you have other ways to interact with not just the charts, but like other things. Oops. I keep opening so many tabs. I'm busting my browser memory here. All right. Anywho, I'm done for the day. Love you guys. We're gonna call it quits. What a great video. We should probably clip that for the new Red Line education, because I'm always gonna remake some of those videos. But anywho, that was great. Thanks for tuning in. Big things are happening with our company, and we couldn't be more excited than ever. Like I said, we're going to launch the world's biggest trading marketplace, the Amazon for trading. I mean, we're going to have the ability to have more things than any other marketplace does, by far. We got our own trading platform, custom widgets, custom things, anything a trader can want in one spot. And you guys can have more flexibility in like what you use, what you learn from. You can leave reviews, you can interact with the vendors, all kind of fun stuff. We're trying to make it like trader directed, where the things we've always wanted as customers ourselves will be there. And we're trying to keep it like honest and direct. You know, you're going to make sure that everybody in that marketplace is not breaking the law, not doing things they shouldn't do. We're going to vet people for you, so as best we can. We're going to let people run crypto scams and pump and dump schemes and shit in our marketplace. We're going to utilize our power and influence to mop up the floors of Wall Street. And hopefully you guys want that. We'll see y'all later.